Welcome back to Become Sensible, where we discuss about practical business, finance, tax, and strategy for your sustainable growth. My name is Fiona, and I am a CPA. For the last decade, I have been spent a lot of time to help the CEO business owners not only make the business decision better, but also transform their business financial health. Today episode might be one of the most important one. Yes, we diving into why small business and business fail in terms of financial and provide you with a comprehensive survival guide to ensure your business will be thriving. And the reason why this is very important topic and episode because according to the US Bureau of the Labor Statistics, 45% of small business don't make it past their first 5 years. But the truth is that the US Bank conducted a study showing that 82% of business failures stem from poor cash flow management and financial oversight. Not about the business idea, not about bad product, not about weak marketing, not about competition, but it actually from manage the financial. So today I want us to change that narrative, and I want to be a part of the people who help you to change that narrative. If you are a small business owner or you are the business that is scaling and needs to support us some comprehensive guide in terms of manage your business financial, I think this episode is an absolutely helpful for your business situation. So in this episode, we give you some financial survival toolkit. We talk about like the 7 most devastating financial mistake I see the business normally like make repeatedly, a comprehensive checklist, one inside that your business might be in a trouble, and a step-by-step actionable plan to strengthen your business financial operation, and some case study to give you like more a practical example on how to apply it in the real life. If you watch this episode on YouTube, you probably see like the sunlight a little bit strange, but this is winter sunlight. We cannot do anything to change it. So it is what it is. So let's dive into the episode. The first thing we talk about like common financial pitfalls. So financial stress is not like rarely analysis itself. Like okay, here I am, the financial stress, but it actually it creep into like seamlessly, like innocent mistake that compound over time. So I think like the concept of compound in finance is absolutely important. That is where that the compound interest. If you put in the $1, $10, $100 and invest it regular over time, the compound interest it will give you the dividend and interest in long term and it's become a large lump sum amount. It's the same thing, this compound way that is also applied in if your business facing the financial challenge or if you actually get a loan from the bank, the interest is spent is also almost similar way, the way that compound interest and dividend in the investment. So let's talk about what is the common pitfall that show your business is going into the difficult financial situation. First pitfall is poor cash flow management. So let's start with this. And I know on my podcast, we have a couple episodes now talk about many different way in terms of cash flow management. Like what was the reason why the cash flow have a challenge, how to do cash flow forecast. What people don't understand is that many business, even you make profits, but if you don't manage the cash flow, your business can be like very profitable on the paper, but on the real life, you will face the challenge and maybe like go to bankruptcy. Business totally die because of cash flow situation. And one of the reason is the timeline mismatching. So if you need to pay the deposit to your suppliers, but your client, your customer don't pay the money for you first, money coming in to you within like 30 days, 45 days, but the money that you need to pay for your vendor, your contractor, your staff is due right away. That mismatching of cash inflow and outflows is like normally the reason why you face the cash flow problem if your business make a profit. And then the second thing is by seasonal or by the nature of your business. If your business is live event that will happen couple months per year, then those time you have a huge influx of cash. But like evenly throughout the year, you need to pay for your employee, your contractor, and then a high volume of transaction that you need to disperse. But around the event time, it is very congested in terms of cash situation. Or if you in the business of like sushi restaurant or like ice cream, normally like during the winter, people don't feel like craving for this food, and it's normally like slow down compared to like during the summertime. So it's like more seasonal, and you need to be like able to predict the cash flow so that you can see like where is like influx of cash and how you can like even out your cash management throughout the year when you don't have a huge influx of cash because of the business is slow down during those seasons. The big four number two is you don't have a financial system. And this is very important to understand that if you are sole proprietors, you can like track everything you spend on the spreadsheet, and you can do it like once per month, 2 months. But if you actually have a business in place, a real complex transaction, you have a team. I mean, like, so proprietor is real business, but I mean, like, real operational obvious. It's like you have a team, you have a deliver need to come out. Your business have a ton of complex transaction and volume. You actually need to have an accounting software to do it because it's faster, it's efficient, and it's give you more real time of information. At least you get it per month, at least. But like it's give you more real time information. If it take you months to produce financial report, that is absolutely something wrong. In terms no standard processing of invoice and collection, no system to actually review and track your expense. And I tell you this, like over spend, even a small 1,500, whatever the amount that you think in your mind is very small. But if it's a large volume of transaction of this spend, it add up together. And if you don't manage it, like review it every single month to actually double check it, you will may spend thousands or tens of thousands of dollars, even more than that, on the spend. It doesn't make sense a direct return on investment in your business. The number three is the pricing's problem. So normally pricing have like some of the business never very like rely heavily on cost plus pricing model without like market consideration. One of the reason is like, for example, you charge for that package is $1,000, but on the market it's actually like people charge for 4, 5, even like $10,000. It's like more for you. And then so the way that you charge is under price of the market. And then you try to over delivery. That's why it make your profit margins very low. When your profit margins very low, there's no cash left for you to actually build up the cash flow for you to build the reserve and all of that. So it's very important to charge enough in the way that reasonable. And I can talk more in the back after this, but it is more reasonable and in a way that you can have a reasonable profit margins that help you to build a reserve and build a cash flow for your business. And then failing to account for overhead costs. And I see this all the time. Overhead costs is like cost you at least 30%. At least 30% of your business is spending actually operational and overhead. And if you don't account for this, your pricings always will be underpriced. And then part of like not adjusting price because of inflation and cost increase, especially for the last couple of years, the inflation is very high. And if you in like food industry, like all of this egg and milk and all of this, it directly changes the cost of production for your business. And if you don't actually adjust the price in the reasonable, I don't let you take advantage of situation and then increase the price like tremendously, but need to adjust the price compared to the cost that will reflect the net profits for your business situation too. And then like finally is emotional pricing, that fear of losing customer our clients. But one of the things that you need to understand is like sunk costs. Some of the clients or customer, there's no longer give you a like profit on that relationship or on that transaction anymore. And if you feel like, okay, you need to hand on this because of history or information now, because that you invest so much in that relationship to build that client relationship. But at the same time, if you don't make the profits now, you don't make the profits in next 5 year or 10 year because you don't build it in a reasonable expectation between the pricings and the delivery. The same way if you do B2C, it's like direct to the customer too. And many people don't understand that they just hang on to that part. Was we not value people just only based on the money. But if you in the business and you lose the money, the first person will have a big problem is you as the business owner because you lose the money on the table, and there will be the very challenge for you to actually sustain the business if you don't make the profits. Of course, like compassion and empathy toward other people and treasure the relationship. But at the same time, as the business owner, sometimes we need to make to understand the priority of the business need to make the profits or at least make a break even point to be like survive and like growing year by year. It's not gonna be like able to, it's not gonna be like great if you cannot survive. And so always adjust your pricing to reflect your business situation too. The next pitfall number 4 is insufficient financial planning. And this happen all the time that many business is just hiring, growing, scaling the business and the way that they make the operation without the planning thoroughly. And I just always say this again and again, that is you need to have a strategy and a planning. Whatever the strategy that you have, you need to have a plan to execute that strategy. For example, if you want to grow the business into like from 1 million to 2 millions, for example, that is double growth stage. It means that you need to have the delivery team, you need to have an operational system, you need to have the marketing costs and the sale, the capacity, everything it needs to be plan and coherence with the strategy or the goal that you set for the business. Because we wish for like the magical thing, but most of the time the magical people always say magical thing, but it's just go with strategy and planning, go with it. This will be like no miracle that in the way that you just suddenly come out and get 1,000 clients right away. You can blow up on TikTok to get the number of the client, but at the same time, you need to have a certain capacity that available in terms of stock or like inventory to make sure that when you have the big scaling in terms of marketing, you have the capacity to handle it. You cannot be out of stock all the time because that will create a very like discourage to your customer. They don't want to coming back because they say it's never had the item available. So if you go blow up with your content, with your TikTok, with your marketing, you need to have a certain like inventory, like 70% and 65% of that. And then after that, put people onto the waiting list or something similar. But always need to have a like certain percentage of capacity or inventory ready to make sure that you can serve your customer or your clients. And finally, we talk about what is the warning sign of financial trouble. Okay, so what is the financial warning sign that we know that this is coming? The number one, the immediately red flags is number one, a decline of gross margins. What is mean that all your costs, direct costs, eating into your revenue. Gross profit margins is equal to revenue minus of direct costs or cost of goods sold divide for the revenue. For example, you sell the product as $100 per product. Your direct cost is $30. Then you get 70%. 70 you divide for 100 is 70% in your gross profit margin. And a healthy rent in most industries is from 40 to 70% in gross profit margin. Unless your industry have a very small operational expense. But most of the time, I know operational expense it will at least 30%, but not that even more. Some industry, it actually like costs like 50% of your revenue is your your operational expense. So make sure after direct costs, you need to have enough amount of money profits to like cover the operational expense. And number one. Number two, aging account receivable. It takes so much more than 60 days to 20% of your account receivable is over 60 days. Its impact in terms of cash flow and collection efficiency matters. So you need to change the way that how you manage with account receivable. Number three is inventory turnover slowdown. If your industry face the challenge in terms of any inventory carry, it's always have a carry cost, the warehouse, all the technology to manage, and also like some of the product is become expired and it's become worthless. So make sure that in terms of inventory, if you in the industry don't have a physical product, you need to make sure that you actually manage the inventory very well. Otherwise, expire or like it's become like irrelevant to the markets. So make sure that your production, your inventory management is need to be on point on that part. So then other advanced warning indicator. Number one is working capital problem. So normally optimal working capital is from 1.5 to 2. What is working capital? Working capital is equal to current asset divide current liability. What is current assets? It's like your cash, your account receivable, your inventory, or any like easy to convert to cash divide for current liability. Current liability is on the balances too, and that is including the short-term credit card, any like short-term liabilities, your short-term loan, your payroll payable, those things, or your account payable, those things. You divide, and it need to be current asset need to be 2 times, 1.5 and 2 times of your current liability. So if you don't manage this part, your liability is so huge and you will not have enough cash to, to cover your short-term liability obligation. So need to make sure that you watch on this. So the second thing is a customer concentration risk. What is customer concentration risk is in financial audit. We always say this high risk if you have a client make up around like more than 20% of your revenue. So because if anything happened with that clients, if they have a financial problem, they have any situation going on with their business, you lose a big chunk of your business revenue and that puts you in a very challenging. So that is why in terms of your revenue, you need to have a strategy where the revenue stream coming in, where and need to have a diversified sort of client base. And that's help you to like avoid the risk, high risk, so much focus and concentrated in one or two clients. Number three is operating cycle, the time between like purchasing inventory and receive the payment, the time between like the client payments and the delivery work. So these things need to be like in the same cycle. If your payment to your vendor, your contractor is within 15 days, but the payment from your client coming into you or your customer come to you is like 45 days. That's in that 30-day difference, it will be like challenging in terms of your cash flow unless you have a huge cash flow reserve. So how to prevent all these crisis measures? So this is why key performance indicators, which is we call KPI, is absolutely important. The number one KPI is the break-even analysis. You need to know, okay, whether what is your fixed cost, what is your variable cost. Every month, how much will be your break-even point? Most of our clients who on the accounting advisory with us, they know exactly how much every month is their break-even point. Because if you can't remember any number, any digits on your financial report, you need to know as the business owner or the CEO of your company, okay, we need $100,000 every single month around that number to make the break even. If cash coming in not cover that $100,000, what will be the thing that help us to cover that expense? Whether we have a reserve, whether we have a funding for that, whether we need any activity to actually generate that number right away. That just need to be one of the most top priorities for your business, especially in scaling business, because it's so much thing going on and moving at the same time in your business. So this very quick number that you can remember is absolutely important. Number two, a cash burn rate. Monthly cash burn calculation. How much is your runaway? Like for example, like you say, okay, every month that's is $100,000. Now you have a $500,000 in the bank for reserve. That's just 5 month runway. But if you say like, okay, you just have a like 100,000, that's just 1 month. Will your revenue stream, your revenue forecasting, actually matching with the potential of revenue coming in that will cover after 1 month? That's actually very important. And that's just why I say forecasting and cash flow management need to go hand on hand, because the future of cash flow projection is depends on financial planning in terms of revenue stream coming in. And the next one is profitability ratio. Always remember on top of your mind, how much is your profit margin? That is 70%, that is 50%, that is 80%. What is your net profit margins? Is it that is 20%, that is 30%, or that is 10%? You just need to know this top number. You don't need to detail, like if you're a CEO or like managers of company, you don't actually need to detail, okay, every month I spend $3,000 in software or like $10,000 in ABC. Sometimes you don't need to remember that all the time, but you need to know all of this top and important number, because with that, you know, okay, if the proposal that we put into the client, if this is $10,000 proposal, if your gross profit margins is 70%, you know that you will make 7,000 from that. And you need to cover your operating expense like 30%. You cut down right away, it's three. So it's $4,000. Will you pay tax or any other? And how much is your net profit margins like 2,000 or 3,000? That's help you right away the calculation in terms of like, okay, how much is will go into the reserve, how much is treasury cash right away. This help you to make the financial decision, especially on the spot, so much faster, and help you in terms of negotiation with your potential client. Okay, so all of the things that we need to watch out and how to like avoid this. So what is the actionable solution? Okay, here's is couple things that I suggest you, and this is I say to you is very comprehensive in the way that help you prepare for and avoid these and have your business very stable in terms of financial and thriving the business at the same time. So number one is financial system overall. Like again and again, if we don't measure a thing, we never can make the decision. We don't have the information to make the decision at all. So have your accounting technology stack up, set it up, accounting software, payment processing, account receivable, expense management, financial dashboard. It needs to be having on hand. If you can't do it yourself, you need to have an accounting and financial team to do it. At least a bookkeeper, but bookkeeper, they keep the information in, but sometimes they cannot give you the whole picture of your financials. So you need to have the people have a little bit like more advanced skill of like reading your financial data. And that's just why normally like with us, we meet the client once per month. We have them to understand their financial situation, understand what is the number actually telling them. And normally it's make them make the financial decisions so much faster and efficient. Number two, cash flow management system. You need to have a cash flow forecasting. This is 12 weeks, rollover forecasting templates, scenario analysis, that is sensitive analysis, cash flow driver analysis, whatever it is, you need to have at least one cash flow projection forecasting in the system. And there's a lot of them, but you at least need to have one system that's simple, no cash in and cash out. What is the net cash of it? Beginning cash plus cash in minus cash out equal to ending cash. And that is like the most easy way for you to remember and track all of this and make sure that you have at least for 12 weeks, which is normally 3 months, so that you can forecast the next quarter how it's look like. But if you can do it like for a longer period, that is wonderful too. Build an emergency funding. One of the thing is emergency funding is not negotiable at all. People will say, like, I don't have enough cash to transfer to reserve. I say it's required a financial discipline. You need to make the decision today. I need to transfer 20% of every dollar that my business make to reserve. And if anything left and I can't manage that expense part, I need to think about whether my expense need to cut or whether I need to drive more revenue. But without cash reserve, you put your business in a very high chance of financial failure. And I just want to repeat it again and again. If your business fail in terms of financial, there's no chance for your business idea, your talent, your skill, your goal survive in long term at all. And I mean, and that is all. So it just need to be the first priority. This amount of money, 20%, 10%, 15%, whatever that number that you make the decision, don't touch it. Don't touch it until the real emergency situation. But have a strategy and planning in the play that to hopefully that you never actually touch that emergency fund at all. Number three is grow planning framework. That's I always say planning needs to go with execution. You need to have a strategy for the whole business at the beginning of the year. You have a budgeting process, you have quarterly review. You need to know whether it's like what is your marketing, your sales, your operation, your human resource, your technology resource, your funding resource need to work together with that strategy. If your business considers scaling, need to have whether you have a capacity in place, whether you have a infrastructure requirement, staffing needs, technology needs, location needs, all the base cover. And then what does marketing cost for expansion and all this? Of course, there's no way we know every single thing and there's no way we prepare everything, but always have the plan so that you have like couple scenario in your plan. You know that, okay, what's situation A, what you will do, situation B, what will you do. And this help you avoid a lot of financial pitfall because it's something just happened. And that is why one of the things that this year I really deep dive into all of these assessment, strategy, planning, so that thing is actually like coherence in terms of how we move forward. It's not matter how fast you move forward. Of course, in business, we need to be fast, but at the same time, you need to be fast in the right direction. You can't be fast in the wrong direction, and that's eventually like make you pay for that cost. So finally, we talk about like a real case story that we have a lot of clients that in the service industries and marketing agency, and they have a very high revenue, but very low in terms of profits. So we look at into their financial situation, we assess it, we change in terms of strategies, in terms of their pricing, in terms of their offerings, and cut from 10 offerings to become just core 2 to 3 offerings, and that's it. And it's not overwhelming to their customer, to their clients, and number one. Number two is also not require them to custom the solution for client all the time. And that when you, anytime you custom again and again, it requires you very hard for you to scaling because you cannot become like a framework for a repeatable process at all. And it's very hard for your staff to training do from client A to client B to client C. And so cut it down to be like couple very core and we standardize the process and offering and deliver and the pricing. And we give them like a financial overhaul in terms of pricings, in terms their financial report and analysis to help them to look at their financial in a different perspective. And that eventually that helped them in like, I think like a year, it was double their profitability in that situation. So with all of this information, it's like a lot and it's overwhelming with information. So I suggest how to apply the this suggestion and framework. Number one is a priority assessment of your personal financial situation. You need to know exactly where you are at, what actually is not performing and what is actually performing well. You have your strategy, what you actually want to move forward. Where's your target audience, your target clients, customer? What is the main offerings that you go with it? What is your pricing strategy? How is your operational capacities and marketings will look like? And then allocation your resource, and then how to track between the progression towards with your budgets with your plan. And one of the things that we do is we have a KPI every single week, which is I didn't do it before, but I eventually learned that to see that actually we, of course, we have a budget and we normally we compare with the budget, variant analysis and all of that, but it's a lot more of work in terms of like the exercise itself. And I just decided that I need to have a like weekly KPI on this couple main item. That once I look at those KPI, I know exactly where we are. And then from there, we adjust strategy and our action in the next week. And that's proved to be like super more helpful than a giant spreadsheet that you have so many tabs that you do so many different things, but it actually overwhelming information for a CEO or like for a business owner to look at all this information. Just pick up some main KPI to make sure that you look at it, you know exactly where thing is, and you have the action to implement it. So I hope that this episode is super helpful for you. If you need us in terms of business financial assessment, we're happy to like help you and serve you in that part. And also like can choose our newsletter. We have a weekly newsletter. It's give so much in terms of like business mindset, business strategy, business perspective. And so it's just very like super helpful for our subscriber. And I thank you so much for your time today that you choose to invest your time for your business financial future. Don't forget to subscribe, give us the comment, rating us, and give us what is the thing that you want to learn more or you want to listen. And we will try the best to help you with. So thank you so much for your time, and I cannot wait for the next couple episodes. Bye-bye.